So you've bought a home, taken out a mortgage, and started paying that mortgage down. Congrats! You, my friend, have equity in your home. But how can you actually access home equity? Because lucky for you, that value doesn't have to just sit there. It can be tapped to help pay for expenses in the real world. Subscribe below and keep watching. First things first, what exactly is home equity? Well, it's the portion of your home's value that you own outright. In other words, it's the market value of your home minus the amount that you still owe on your mortgage. So let's say your house is worth $300,000 and you still owe $100,000 on your mortgage. Your home equity would be $200,000. But remember, home equity isn't a static number. Two main factors affect it. The first is fluctuating home values, meaning if the property becomes more valuable, the equity increases. And the second is how the more payments you make, the less you'll owe, and the more equity you'll have in your home. Home equity is an important asset, but it isn't so easy to access. That's why it's worth learning how to take equity out of your home. So, how does one calculate their home equity? With a simple formula. Just subtract the amount owed on your mortgage from your home's appraised value, and you've got your home equity. Let's say your home is worth $200,000 and you still owe $50,000 on your mortgage. That means you'd have $150,000 in home equity. Congratulations, hypothetical homeowner. That's pretty good. But there's another number worth calculating, your loan-to-value ratio, or LTV, which shows you what percentage of your home's value you still owe on your mortgage. Let's use the same numbers as before. So your home is worth $200,000, and you owe $50,000 on your mortgage. LTV is usually shown as a percentage. That means your LTV in this scenario is 25%, which is awesome. Remember, LTV is like golf. The lower the number, the better. This ratio is especially important if you're considering applying for a home equity loan. Most lenders use LTV to determine how much of a risk you'd be as a borrower. Lenders are often willing to give loans that add up to around 90% of your home's value, but your current mortgage is part of that 90%. So if your LTV is currently 25%, you're likely to get another 65% to work with. Now that you know how to calculate, wouldn't it be nice if you could access home equity for groceries, medical bills, or whatever else your heart desires? Good news, you can! And you have a few options. A home equity loan is exactly what it sounds like. A loan that's secured with the equity you have in your home. Let's get specific. Lots of loans have collateral or something you offer to give up if you fail to make good on the loan. In this case, the collateral is your home equity. You'll get the money as a lump sum, and then you'll pay it back with interest. Most home equity loans come with a fixed interest rate, meaning it's locked in. The risk here is obvious. Fail to make monthly payments, and you're staring a foreclosure in the face. You could also be in hot water if the value of the property takes an unexpected dip. But that doesn't mean a home equity loan isn't right for you. It just means you should consider other options before making a final decision. A home equity line of credit, or HELOC, is like a home equity loan, except you get a line of credit instead of a single lump sum. That means you can borrow up to a certain amount, but you don't have to. Basically, it's like having a credit card, but one that's secured by the equity in your home. One thing to consider, a home equity line of credit usually comes with a variable interest rate. That means your rate could go up even after you've signed the agreement. Unlock is a service providing home equity agreements, which allow you to access home equity without using a loan. In exchange for an upfront sum, you give Unlock a share of your home's future appreciation in value. Your home is likely to increase in value, right? That appreciation will become a profit when you eventually sell your home. So in a home equity agreement, you agree to give Unlock a certain percentage of that profit in exchange for getting some of your home's equity ahead of time. Here's how the process plays out. Unlock sends you money. You sell your home or buy them out within a 10-year period. You pay back the money they originally gave you, typically with the proceeds from selling the home. You also give Unlock an agreed-upon share of your home's appreciation and value since the time you made the agreement. With Unlock and similar services, there are no interest or monthly payments. So if you're wondering how to take equity out of your home, let me tell you Unlock is a seriously solid option. Hometap is another service that lets you access home equity without using a loan. They give you money up front, and you have 10 years to settle. During that time, you can either sell your home and pay them with the proceeds or buy them out some other way. The advantages of this approach are simple: no interest and no monthly payments. One thing to remember though, Hometap isn't available in every state, so check if you're eligible before setting your heart on using the service. Unison is another service for home equity agreements, allowing you to access your home equity in exchange for a share of your home's value. While Unison's model is similar to what you get with Unlock and Hometap, some of the details are different. Let's start with the good news. Unison is available in more states than its competitors. If you're in Wisconsin, for example, you might not have many other options. So, welcome to Unison, cheeseheads. Unison also provides longer terms up to 30 years. That could be helpful if you're not planning on selling your home within the next decade. But here's the downside. Unison requires a credit score of at least 680 to qualify. Not quite there? Then Unlock or Hometap could be better. A cash-out refinance allows you to replace your current mortgage with a new one, giving you access to much of the equity you already have in your home. To use this strategy, you'll have to qualify, which isn't always easy, especially in an era of rising interest rates. And if you pull it off, you'll likely face one of two things. First is higher monthly payments than what you had with your previous mortgage. And second is that it'll take longer to pay off, meaning you'll end up spending more in interest over the lifetime of the loan. So a cash-out refinance isn't a perfect strategy, but it's one to consider as you investigate how to take equity out of your home. Now I've talked about how to take equity out of your home, but there's another question that's just as important. How should you not take equity out of your home? Here are some of the biggest mistakes to avoid. Tapping home equity to make risky investments. Want to speculate? Want to buy stocks or make other uncertain investments? Then do it with money you've saved, not the equity in your home. Tapping home equity to pay for college. There are better and less risky ways to fund an education. Traditional student loans, while costly, are probably a better option. Spiraling into debt by taking out multiple home equity loans. Tapping home equity can feel like magic. Sign some papers, and voila, you've got cash on hand. But it's not so simple. Keep taking out home equity loans, and you'll increase debt without building home equity. Failing to invest in home improvement. Remember, your home's market value lies at the heart of home equity. If you're using home equity to secure loans or get cash up front from a company like Unlock, then you want your home's value to increase. So use some of the money you get for projects that will lift that market value. Feeling like a home equity expert yet? You're certainly on your way. Just remember to stay smart if you decide to take equity out of your home, and subscribe for more personal finance tips and tricks. And a final congrats on owning your home in the first place.